FAANG stocks ruled the market for almost a decade and delivered massive returns, but over the past year, most of these stocks have dropped sharply in value. However, in the fallout, there's always an opportunity, and now two FAANG stocks seem ready to reward investors and holders over the coming years. So, don't miss this video and watch until the end because today, we're going to take a look at these two promising stocks. Hey, guys, welcome to this channel. Millionaires Club is where financial markets junkies hang out together to learn more about investing and trading stuff. So, if you're new to this community, don't hesitate to subscribe to our channel and smash the bell button. Alright, let's go. Two FAANG stocks to buy now like there's no tomorrow. According to Jeremy Bowman, 4 of the FAANG stocks have dropped by over 40% from their peaks last year. But as you may know, there is always a good investment opportunity in downturns, and now two FAANG stocks look ready to reward investors and holders over the next months and years. The first FAANG stock to buy, Amazon. Amazon stock has fallen nearly 50% from its peak a year ago, and its third quarter earnings report demonstrates why the e-commerce giant has dropped. The company surprised investors by guiding for revenue growth of only 2% to 8% in the fourth quarter, predicting its weakest top-line growth ever in the holiday period. The stock dropped 7% on that news and hasn't recovered. But it's wrong to think that Amazon's growth is constantly stalled. Like many of its competitors, the business blamed economic headwinds for weakness, but performance will most probably improve in 2023. First off, the company's most profitable divisions, such as Amazon Web Services, AWS, advertising, and its cloud infrastructure business, continue to grow quickly. AWS revenue climbed 27% in the third quarter to $20.5 billion, with a 26% operating margin. In other words, AWS's revenue run rate has hit $80 billion, with operating income surpassing $20 billion. Meanwhile, advertising revenue increased by 25% to $9.5 billion, or approaching a run rate of about $40 billion. The company doesn't break out profits in advertising. However, it's reasonable to estimate that margins are likely in the 30% range, similar to Google and Facebook. The main e-commerce business has weighed on overall outcomes in 2022 as it has struggled with excess inventory levels, a capacity over expansion due to the pandemic, and also e-commerce sales slowing this year as the world economy reopened. In order to increase e-commerce profitability, the business is scaling back on warehouses and has also imposed hiring freezes in some divisions. In 2021, its e-commerce business, including advertising, brought in about $6 billion in operating income. There's actually no reason this e-commerce giant can't get back there, particularly with even higher revenue. If Amazon starts to perform well again, the stock should experience a major boost. The second FAANG stock to buy, Alphabet. Similar to Amazon, Alphabet stock has fallen significantly over the past year and also fell on its latest earnings report. The Google parent reported only a 6% revenue increase in its third quarter as macroeconomic headwinds affected the ad business, and the business continued to lose billions of dollars in Google Cloud and other areas. Ad revenue even dropped for YouTube and Google Network. Alphabet is also confronting tough comparisons with 2021 when brands were spending heavily on digital advertising. Its revenue increased 41% over Q3 of last year. Management is now responding to the downturn in demand, and the company has decided to dial down hiring into next year. After a 25% increase in headcount over the previous year, that should rein in costs and bring back the company's usual profitability. Alphabet stock has lost about 43% from its peak a year ago, even though nothing significant has changed in the business. The company continues to have a monopoly in search with a market share of over 90% in most of the world, and search advertising still remains a high-margin growth market. In search, the business reported a 50% operating margin in the quarter, which was lower than it was the year before. Alphabet lacks a license to print money, however, the search business comes pretty close, and the only thing slowing it down is actually macroeconomic obstacles. Advertiser demand will finally return, and when it does, the business and the stock will most probably rebound. Thank you for watching this video, guys. If you ever found it helpful, be sure to like it, and don't forget to subscribe to our channel as well. And now, what's your take on these two FAANG stocks? You can share your opinions and arguments in the comment section below.